Hey guys, Mark Anderson here, construction worker turned zero DT hedge fund manager. I wanted to go over some Q&As I've been getting recently here. Hey guys, in order to have this a little more organized so I can get more in depth to the questions I've been getting for you guys, I'll have a Google Sheets, Google Form fillable thing in the description and at the end of this video. You guys can click on that if you want to put in any more detailed questions, Lincoln Options Omega portfolio, or any back test or thoughts about articles or anything. That's going to be the best place to put them so I can dive in more detail and give you guys more detailed Q&As as well. So I've been getting more questions around stop losses, back test, and basically what that looks like. So stop losses will help you protect from risk in most case scenarios and therefore increase your P&L. But we also need to think about our sizing and how we're going to protect against risk for things that our stop loss will not work for. So I wanted to go over that in a little more depth as well to clarify for you guys. Here's the concept that I don't think a lot of people wrap their heads around is like your stop loss is great because it's your first line of defense and it helps you shape the distribution of your returns. It makes a nice curve of what your returns could potentially be. And people will game that to get a good Sharp. However, that long vol significantly drags my Sharp down because it's very convex and reflexive. However, if we were to limit down, like in August 5th, even though I use a stop to improve my Sharp, I actually don't need it. I can wait 15 minutes till there becomes liquidity. I know I'll never get margin called because it's all vertical, then I'm long units. So I could even take it to expiration if the liquidity was gone. And I know intrinsically what my risk exposure is. And like when people just only look at risk adjusted ratios and they can't speak to that, I don't think it's necessarily the best proxy on earth of, how are you actually managing your risk in the worst case scenario, and in a stress test, what does that look like? So that's a little bit different of a thought that I don't think a lot of people think about as well. But even though I may experience a little bit of drawdowns and my Sharp may be a little bit lower, as long as I'm not getting in a 10% drawdown, because then you pay volatility drag, and you can't blow up, that's a huge edge. What I would say is if you have a 0.00001% chance of blowing up, you have no edge. So I've been getting a few questions, particularly around hedging. I am going to make a longer form video that goes more in depth on this, but I wanted to explain a little bit how I view using long vol to hedge zero DT and kind of how I spread that out in regards to duration from 14 DT, 7 DT, all the way down before the day of expiration as well. I do a few. So I have some that I just put on every 7 day and I let them go all the way to expiration. I have some that I put on right before the night before on 1 day and I take them to expiration. And then I'm also reloading. So like I'll take a 7 day, I'll let it decay for 2 days or 1 day, and then I'll reload it because I want that convexity, like I was talking about in the thing. When you buy the vol at the same time when you sold the vol, that's going to be perfectly hedged. Whereas if I had a hedge that went 2 days and then it ripped, that short vol could not offset as much. So I try to balance the cost drag of reloading them and not holding them to expiration with the ability to accurately hedge it. And I basically base this all off of limiting drawdowns so I can continue to compound. So a lot of people kind of with where the market is have been wondering, what does correlation look like and what does that look like in particular for zero DT? So I kind of wanted to take the base number of how to define correlation by and then describe my view on why I think correlation and options in zero DT is basically better than that of something that's looked at like gold to the S&P or Bitcoin to the S&P or something like that. So just kind of in regards to that, it's like I like to think of correlation or investments basically in 2 ways. There's like your underlying thesis, and then there's kind of like a number that's generated to it. I think that like correlation coefficient as a number is kind of overrated. So people will say gold is 0.2 correlated to S&P. Well, it's like when things are screwed up, it's all correlated to 1. So the fact, what makes it undiversified is even though my correlation to S&P is 0.2, and I trade credit spreads that are only exposed to 20% of market hours, I do also hold a lot of long vol. And even though that long vol may be 0.2 correlated to short vol, that's actually inversely correlated because when you need the correlation, long vol bought at the same price is going to be the actual difference. And then
this is the other thing that I like to impress people in correlation. It's almost everyone's assets, Bitcoin, stocks, the NASDAQ, AI stuff, real estate. It's all based on the market going up. And volatility risk premium is counter cyclical to basically all of that. Times are better. The best trading year I ever had is in 2022 and 2020. That's going to continue to be the way it is. Also, like when you're owning a stock or Bitcoin, basically what it's saying, the market is pricing it on. It's saying that the underlying is accurately priced and the options and volatility are not. Whereas at its core, what I'm doing is I'm saying the underlying's mispriced and the options and the volatility are priced correctly. So at its core, all trading investing is finding something that you're confident the price is accurate on and then protecting the risk away from to preserve that edge to compound. And that's essentially what I've tried to isolate within just the 0-day tenor, basically.
I got another question in regards to how do I use separate strategies to basically make a portfolio of 0DT that the sum of the parts creates a better return, as well as how do I use long vol in buying that in the same portfolio where I'm trying to create credit off of income. And the whole key with this is that you understand kind of what the trades look to one another. And the first numbers that I use to understand that is basically beta and correlation. And I'll go a little more in depth on how I view that correlation and putting those trades within one another to make a portfolio.
Yeah. So long vol and short vol inversely, that's great. Then there is like, if we trade at 9 a.m. with a 5x stop, which is like a big stop, you'd obviously trade small. And then if you traded every 10 minutes with a 1x stop, those are going to be usually not related. It's not perfect if volatility expands from 20 to 40. That's obviously not going to work out. But that is how I get most of the diversity, because when I'm selling that 9 a.m. spread, there's an expected move of 30 points. And if I sell a 3:30 spread, there's an expected move of 8 points. So if there's an 8 point, but granted, they could still lose. So that's what I'm trying to do. But since we're making so many occurrences, it's relatively easy to realize that over a period of time. And the other thing I like to point out is I've basically taken the average return and the standard deviation and I ran it through like 1,000 iterations Monte Carlo. The best guess we could have, and in a 95% certainty, which actually is once a quarter, I expect to have a drawdown of -5% and I expect to have a return of 10%. And then as you can see with that near 10% drop, and then you could see with like 14% months or whatever the good ones have been, that's the 3 standard deviation and 99.7% certainty. And we actually touch that in 0DT because there's so many occurrences.
In one sense, that's good.
Yeah.
Showed your model was accurate, right? So.
But the path to get there can be a little jagged because as you see, if I take a 7% dragon long vol, it doesn't take much in 0DT to, dip you down into something a little larger.
Really appreciate everyone for watching us to the end. If you have any other particular questions, always appreciate commenting, subscribe, and engage with you guys and provide as much value as I can as well.